All right, thanks so very much. This has been something I've been looking forward to the entire time I've been here because I have so many questions and I'm so honored and privileged to be a part of this particular group because we're at least going to get some answers and maybe just ideas about what the future of finance, what the future of financial markets and technology will look like. I'm Dominic Chu, Jan Van Eck, Matt Haugen, Zach Pandel, Grayscale, Bitwise, Van Eck Funds, all represented here, and we're going to have a conversation about just what the future of finance does look like from each of those perspectives. So thank you guys very much for being here. We decided to dispense with the formal bio portion of this to kind of save time so that we could kind of get into the program. I guess maybe I'll kick off the conversation with this idea that direct indexing has been one of those concepts that didn't and shouldn't have been a part of the investing landscape for the longest time, because investment advisors have been telling their clients for years, don't micromanage, be big thinkers, be long-term and everything else. And all of a sudden now, you have the ability, because of cost friction, spread compressions, and everything else, to do all of these things and micromanage portfolios for things like tax efficiency and everything else. So I'm going to kick off the conversation with just how beneficial direct indexing and customization at the micro level is. And I'm not going to direct traffic so much individually, but we're going to try to have a conversation and bring you guys into it. So these guys are going to weigh in whenever something strikes a tuning fork in their thought process and everything else. But I have to start with somebody, so Jan, maybe I'll start with you on this.
I knew it. It's great to see everyone. Welcome to Future Proof 2.0. Matt and I were here last year. I look at direct indexing as sort of a subset of SMAs, separately managed accounts. And we're going to talk about today, and we're going to talk about the future. I look at this as almost like a today thing, with the ability of fractionalization of shares, which is another thing, and the ability of computers to do all these separately managed accounts. The real value delivery is tax optimization for your clients, and I think a lot of firms are leaning into that heavily. I would almost say that's best practice today. As far as direct indexing, I think that's a subset of that larger trend. That's very exciting.
Do you think that there's an evolution that's taken place, either of you guys, with regard to how the investing public and maybe investment advisors specifically are looking at the trends with regard to that kind of level of detail and micromanaging of portfolios?
Yeah, I mean, I think the trend that it fits into is it's very hard for advisors to differentiate from each other, and this ability to offer tax loss harvesting within a direct indexing package can appeal to select people. So I think that's a piece of it. I think the other killer app of direct indexing is sort of value-based tuning of portfolios, and that's something that I haven't seen take off as fast as I would have expected at the beginning. I still think that's probably a place that advisors could grow into. But I think it's all about finding additional ways to differentiate your practice from other people, and it'll be a part of the future. It'll be more important in the future than it is today as the costs continue to go down and as the technology continues to improve. It won't be the entire market, but for sure it's not going anywhere. I think it's probably going to grow.
Yeah, maybe one other thing, and focusing on the future, my background is more in institutional finance rather than the advisor world. Certainly in institutional finance, this idea of custom exposures is very far along. A hedge fund accessing equity markets is going to go to Goldman Sachs and get a very specific basket of stocks, not a generic index. And they want to do that because there's unique risks that they're trying to bet on or trying to hedge. An increase in energy prices in Europe or a tariff on China, these types of things. And so custom indexes, custom baskets are a way for institutional investors to take very specific risks in markets and manage their portfolios. I could see that something in the future coming to the broader advised market as well.
How has it evolved, and have you been surprised at maybe the timeline, how these things have evolved over the course? Because it seems to have come pretty quickly. If not, it certainly has in the last 2 to 3 years, but it was in the works already for almost, say, the last 10 ahead of that. But how is it that it became such a big deal in just the last 3 to 4 years, and what exactly was behind that particular quick evolution to where we are right now?
I mean, I think it's technology. The idea of direct indexing has been around for
But has technology evolved that
years.
quickly?
Oh, yeah, for sure. It got to a point where it was relatively easy to use and the costs were exceptionally low. It was always a pretty good idea, and you saw it at large accounts for large individuals were able to do it because they didn't have to worry about fractionalization and cost. So it was really just conditioned until technology got there, and then once it got there, it expanded. You see that in most technology adoption cycles. Things are terrible until they're great, and they hockey stick up. I think it's the same thing here.
And the competitive pressures really kicked in. I think there were a couple of firms that were really leading in tax optimization, and they grew a lot of AUM, and then all the other advisory or wirehouse platforms said, listen, we want to compete. We don't want to lose these clients, to Matt's point.
I think that's right. I think the other factor that was true was so many people lost in the ETF revolution. They sat on the sidelines and they didn't recognize that it was going to be as important as it was. And I think they learned some lessons. So you saw folks like Vanguard move very quickly to acquire their way into direct indexing. You saw that replicated in other instances. You see something similar with tokenization. I think ETFs woke the asset management industry up to the fact that we weren't at the end of history, that new ways would evolve to gain access to exposures, and so they've been quicker to adopt those than they were with ETFs, which really took maybe 20 years for most of the asset management industry to wake up to the reality that they were important. I think they're faster now.
I mean, talking about the end of history, I was meeting with a senior official, a major wirehouse, who basically said they're going to stop approving mutual funds for additional approval. That was a couple of weeks ago. I mean, that really is the end of an era.
That is for sure. I mean, I'm a former mutual fund guy, so it saddens me to hear that. But what exactly was if there was a proximate cause for that? I mean, we know that ETFs have been a huge part of the picture for a long time, and this idea that customization was a big part of it. But what exactly, how does the 40 Act
Two words.
change? Yes.
Active ETFs. They're moving their own in-house mutual funds to an ETF format. And I think they're just like, we can't fight this anymore, the tax advantages of ETFs. And it's not true for all strategies like emerging markets and things like that, but the promise is there and the packaging is popular, so the whole industry is moving.
Yeah, I think that's right. And I think the asset management fee kept fees too high on mutual funds for too long and kept the gap between them and ETF disruptors too wide. But it's an inevitability. We shouldn't be sad for the mutual fund. It had a great run. Like, kudos, awesome, 100 years. You did great. It's not surprising that there's something newer, cheaper, faster, better. I think it was inevitable in that sense.
It's telling that the crypto industry jumped right over mutual funds entirely. We have ETFs and no mutual funds at all, so it speaks to that we're already beyond that marketplace in crypto.
What does the life cycle for an asset class look like now then? Has the paradigm completely shifted with regard to a time frame for adoption, for distribution, for management, for broader recognition? Are all of those things now part of that future of finance? The idea that we saw how many years and decades kind of the maturity cycle took for the 40 Act mutual fund companies to kind of get to where they were. Then we saw the ETF revolution truncate that time significantly into about maybe, I would argue, 20 to 25 years. And now all of a sudden with the advent of crypto in certain parts of this particular market, that time has now lengthened to maybe 5 years, 5 to 7 years. It can't keep getting quicker, or can it? I mean, you guys manage the money. I'm just close. Yeah.
Yeah. I mean, yeah. And you lived through it through commodities, which took a while to mainstream. But yeah, I think it can keep getting quicker, right? Information spreads faster. Technology moves faster.
I think AI adoption is going to be lightning fast. I mean, look, there's literally not one conversation we have with an advisor that's not seeking, how can I save time in my day? And we can save chunks of time in our day. What we're talking about this morning with colleagues, I love podcasts. And, you know, you just summarize it, what's a summary of the latest Bankless episode? This was thrown back at me, which is supposedly is very interesting, by the way. And, you know, ChatGPT in whatever seconds gave the 3 bullet point summary of that podcast, which, you know, my dogs will be mad that I'm not walking them during that podcast.
So, Zach, because we now brought up and opened that door/window to the AI conversation, there's probably been nothing bigger in the news cycle, from a news person's perspective, over the last 2 to 3 years than has been the story around AI as a theme, and then the companies that benefit from that particular move, or the industries that could be disrupted by that kind of technology. how much in your thinking of the investing landscape going forward is predicated on what you anticipate the trajectory of AI technology and adoption to be? And it resonates a lot more with the folks here on stage because you guys all deal with frontier edge technology and constructs.
Yeah, absolutely. I mean, I think the thing I'd say first is just at a personal level, I cannot stop using these tools. I mean, as Jan is highlighting, you know, the research team at Grayscale, we are using a bunch of different tools. I'm on Perplexity all day long, for example, and I am starting to wonder what I did without it. You know, I don't use Google anymore. These tools are so much stronger. So, you know, I think for investing at a macro level, it's just about productivity. I mean, I think we will get a productivity boost for the economy as a whole from these tools. Investing is tough, though. NVIDIA has been sort of the play and some of the large cap tech stocks that have acquired AI software, but it's still a little bit difficult to know exactly where to put your chips on this from a market standpoint. What I'll lean into is the crypto side of it, the blockchain side of it, which is where we specialize. You know, I think anybody that has used these tools and kind of got their head around how powerful that is, will start to wonder, well, aren't these things controlled by a small number of countries? And what if I were to lose access, companies, what if I were to lose access to these tools? Blockchains or decentralized AI technology can help us ensure that we get decentralized building, so it's not just concentrated in a small number of PhDs at Microsoft, but many people can contribute to these models, and that we can get open access, that anyone around the world can access these tools. So from a Grayscale standpoint, that's where we're leaning in, is investing in decentralized AI technology, and we think that'll be another blockchain-specific angle of growth for this tech.
What do you guys think? I mean, from a Van Eck and from a Bitwise perspective, how much has it been a disruptive factor, and how much are you, so to speak, leaning into this, and how exactly do you deploy resources to best position yourself to capitalize on any successes that can come of this boom in interest and funding for AI?
I mean, I look at it in 3 levels for today. Individual use, like Perplexity, easy to say, here, go use it, subscribe. Second use is within departments, like here, put your notes in this investment team on one platform and do some analysis on it. What they say about ChatGPT 5, forget all that's going to replace all of us. So that's a little frightening. I'm usually an optimist, but like I don't know what to do with that. But that is literally what they're saying. It's like forget individuals, forget teams. It's just one answer. So I don't know. We'll know.
I mean, I'm going to be obsolete.
It's what they say. It's what they say about 5.
Yeah, we will see. I think it's broadly an equalizer between small and large firms, which I like a lot. It makes us more efficient and faster and able to do a lot more at Bitwise with an 80-person team than we would have without it. I feel like we're operating at the scale of like a couple 100-person team, in part because you can just move so much faster. The research is so much faster. The coding is so much faster. And I don't think we're like the world's greatest adopters of AI. I think that's true across the board for anyone who's at least leaning into making it part of their everyday work.
What do you, I mean, you mentioned the cost and the equalization factor for small and medium-sized firms versus large ones. And that is something that AI can certainly try to close the gap on. But there are still conversations being had about what it costs to be more adoptive of some of these technologies, and that the scale it requires for some of these things on a unit cost basis are way more still advantageous to the hyper side of things, the large scale side of things, as opposed to a small or medium-sized business or investment advisor who's looking to capitalize.
Have you ever seen the cost of a Bloomberg terminal?
I know,
I can tell you Perplexity is way cheap compared to that. So maybe for us end users, we're at the nice side of the economics, and maybe that changes. But right now, that's why let's go play with it and use it as much as you can.
I mean, what do you think, Zach? Is that the way that you have to look at it? Is that
absolutely.
This is the way you have to do it because it'll only help you close the competitive gap?
Yeah, no question. If I were Microsoft and investing to build these models, I would be wondering about the ROI. But as a consumer, you just have to try it. And I think it takes a little while for it to click. You know, how you're going to use this for coding, for research. I use it in my personal life. But I think once you start playing with these tools, it becomes obvious how advantageous they are. And I think we, just as an anecdote, at a research level, I think we have eliminated our need to hire junior people. I don't think I will hire a junior analyst.
I don't know if that's a good or a bad thing.
Well, maybe have negative for the economy, but it's a huge cost saving for Grayscale.
I would say you saw a number of banks shut down parts of their intern program. I think that's a very real thing, a little bit scary. As users, you're absolutely right, though. We get to ride for free on the back of all this VC money that's overfunding this space, or at least aggressively funding this space, and get these incredible tools for like nothing. It's sort of amazing. So you might as well, just like we used to ride Uber for cheap, you might as well do that as much as you can while you can on the back of that VC money.
Do you feel as though, to the group here, and weigh in as you see fit, do you feel as though the current pace and trajectory of funding, fundraising, investment, CapEx, and everything else that goes into the artificial intelligence theme is going to continue at the same growth rate that it is that we're seeing right now? Or are you planning for some kind of change in pace or trajectory in the next 5 to 10 years? Because it sure seems like NVIDIA has to put out a new announcement of a new chip at least a year in advance, and it might even be quicker, but that doesn't seem conceivable for the long term or even believable.
But I would just say something absolutely has to change. You're not going to have hundreds of winners. You're going to have big leaders and network effects around these leaders. So you'll see a narrowing of the field and some lousy return on investment for people that didn't win the game. And we believe that there will be a role for decentralized AI, that you will see blockchain-based infrastructure allocate to investment in a decentralized way for many thousands of people to contribute to these models rather than a small group of high-powered teams at big firms. So definitely things are going to change it, and that would be my bet, that there is a large addressable market for decentralized AI, and that's one of the ways in which capital allocation will change over the next, say, 5 years.
Let's say that is the case, assuming that's hypothetically going to be the case. How would you, as companies or as resource allocators, capitalize or take a view on that particular move or trajectory, if that makes sense? Like how exactly, as executives running operationally, management companies like you do, invest in it or
Well,
take
I can
advantage?
tell you where companies are spending money is organizing their internal data. And that's not organized well enough. And so I was meeting with someone at one of the top 3 consulting firms, and AI is like their biggest growth driver because people just do not have their data organized. It was that second use case I was talking about, like getting departments to put all their notes in one place and bringing in all the different sources of data. That's just a lot of work. It's a lot of data management work, and that's right now where companies are spending a lot of money.
Yeah, I think that's a big piece. I would say the other piece that probably gets overlooked because it's not sexy is just really emphasizing to your team to make this a part of their everyday work. I think there's a lot of advantages that come from using it every day, and it's hard to get people to get over the hump. I actually think there's a lot of sort of managerial wins to be had just by enforcing, like, no, take the time to use this. It's going to accelerate you.
Shut down access to Google search.
That's right, exactly.
Just shut off Google right now. Okay, there are also firms that are either trying to right now or in the future look to do some of the consulting or advisory work on helping companies to reach those particular levels, to reach those particular milestones so that they can then more broadly organize their data, train large language models, use AI more effectively. Is that something that any of you guys are contemplating at this point with regard to do you bring in experts from the outside, or do you feel like it's something that you can do internally to kind of bring that all to fruition?
I don't think it's necessary. I mean, I think that's part of the magic of these tools, that they're so incredibly easy to use. I think it's just about getting the intuition of how to use these tools and starting to get in the practice of writing the prompts and getting the analysis. Maybe it's because I'm a research guy that these things are so valuable, but I don't think it's required to have expertise. You just need to sit down with the app on your phone and use it over and over, and you'll get a great feel for how helpful it can be in both your personal and professional life. We use this in my family for thinking about what movies we want to watch on Friday night. We ask Perplexity. So it's very easy for anybody to use these tools. I don't think it requires a big team of consultants.
Yeah, I agree. It's like, that sounds like hiring a consultant to help you learn how to tweet. I think there's,
I might need help on that.
I think that's probably unnecessary. I think I agree.
Okay, so if that's the case, you were going to say something.
Well, I was just going to say, if people are looking to two things. Number one, these tools are getting better. There's not even like a product life cycle. They're just getting better constantly. And then the other issue, I was going to say, I don't know the answer. What's the best large language model? I have no idea. No one at Van Eck has any idea. I think they may have opinions, but they have no idea. But there are now software applications where they'll pick the right model for the right thing. So there's a company called finchat.io. I encourage you to go play with it. And it has agents that pick that model. So really, there are already people with, in different, what they call verticals, right, or different industries, adapting these things that are a little bit more complicated than us just using and playing around on our own. But those things are changing, they're getting so much better every month.
So the getting better every month, the getting better every day thing has applied to many of the financial products that we are now either actively using or contemplating using. And one of those big reasons why is because there has been an evolution of technology to allow more transparency and security in those financial life cycles and chains at the same time. The idea of tokenization is something that has really become much more of an issue or much more of a focal point in the last couple of years, 2 to 3 years, and again, has been kind of in the works for 5 to 7, maybe even 10 at this point. The future of finance, and again, I was telling you guys, maybe a half dozen conversations in the last 24 hours with people talking about tokenization and how they think it'll change things. Very blue sky in nature, very large level macro thinking in nature, but there is nobody who can definitively say that aspect is going to go a certain way. I wonder if I open up a question to this group about what you guys think it looks like, this idea of tokenization, and what exactly it means for people's investing and perhaps even just security for their personal finances. And Zach, I'll start with you on that one.
Okay, that's a big question to begin with. So tokenization, just another way to architecture our financial system. And I think the simplest way to think about it is if I'm sending you a payment today, really what happens is there's a debit in my bank account, and over a settlement process over a couple of days, not on the weekends, not on bank holidays, not in the evenings, it eventually makes its way to a credit in Dominic's bank account. That's the way our system works today. Tokenization basically just means we're cutting all that process out, and I can send you a payment directly. You have an account, I have an account, I send it directly. And the place where that's taken off fastest is stable coins, and I'm sure everybody could weigh in on this, which is just tokenized cash. It's a different way to set up our financial system without that centralized intermediary, and if it benefits from the things that blockchain technology gives us, which is instant settlement, no intermediaries, and global access. And
True decentralization.
True decentralization. And those are real efficiencies. Even things like instant settlement is a major efficiency gain, in my view, on the financial system. And so stable coins are where the clearest adoption is on these technologies today, on tokenization technologies, but there's many more things that are coming behind it. And so maybe I'll begin there, but there's plenty of things to touch on.
Yeah, I would agree. I mean, most of what I think about tokenization is the way that most people talk about it is completely wrong. They tend to say two things, like we're going to tokenize the dry cleaners business and I'm going to trade shares. Not going to happen. Or we're going to wake up one day and instead of trading stocks on the New York Stock Exchange, everything is going to be tokenized. That's not going to happen either. Those are sort of fantasy dreams that develop pilot projects that end in tears. I think where we're seeing tokenization work is two places. You mentioned it, stable coins, and then the second is tokenized treasury funds that are bought by crypto native users. I think if you want to look to where tokenization is going to work, it's going to be people in the crypto community accessing non-crypto assets and building out the rails of tokenization in that space. Today, it's dollars, it's treasuries. Soon, I think it will be other bonds. Eventually, it will maybe be stocks. But it's going to come from crypto native people up. And it's only after it matures and gets established in that vein that traditional finance is going to come enter that space. I really think people get the direction of travel upside down.
Fair enough. I think I would add, so what are the consequences of that? If you're a registered investment advisor, you can probably ignore tokenization for now, unless your clients get frustrated that they can't move money over the weekends and things like that, because if so, then there's a use case for stablecoins. If you are here and you work for a bank, I would hedge your risks, because I think stablecoins, like a lot of digital assets, are coming after profit centers of banks. And I think their old model is busted. You guys have a great ad on that, like the guy's sleeping over the weekend or whatever the banker's doing, right? So I think those are the kind of consequences. One last thing I would say is, if you want to track the world of tokenization, you know, for some reason, I hate this, but I went to law school. They have a different word for everything, right? So tokenized assets in crypto world is called real world assets. Don't ask me why something digitized is called real world. But anyway, if you want to track this on a daily basis, go to rwarealworldassets.xyz, and you can see stable coins, who the biggest ones are, market share, what chains they trade on, and asset growth. So I have no connection with them, but you know, I love free websites where I can learn a lot.
I think that's right. I would add that most people who aren't in crypto understate the importance of stablecoins. I think stablecoins will be a multi-trillion-dollar market in a year or two. I mean, they're just such an incredible killer app. They put dollar bank accounts in every cell phone around the world. They allow you to access liquidity on the weekends. Increasingly, they're going to be used for, you know, settlement and collateral for futures and other things. I think it's probably the least hyped area of crypto relative to its true potential.
If you look on that website, it'll show you the last month's volume in stable coins. It's way higher than the AUM. It's $1.5 trillion in the last month. Annualized, that's more than Visa's transaction. So it's like what Matt, I agree with Matt. Like it's an underappreciated development, and again, it's going to hit the banks way more than registered investment advisors.
And just to throw one point on that, the largest stablecoin issuer makes as much money as Goldman Sachs. Just like crazy, but true. Give or take.
It is amazing. Yeah. If I can add one comment to this, just for the advisor audience, I do think from a business risk standpoint, a place like Goldman Sachs or a traditional commercial bank is more at risk from stablecoins and tokenization. But I do think it's relevant for advisors in the sense that there's a way to put exposure to this in your portfolio. If you believe that things like stablecoins, tokenization, decentralized, borderless finance, if that's the kind of thing that you want to express as a theme in a portfolio, then Ethereum, which is now available in the ETF structure, is the best way to get that portfolio access. So this is a kind of technological change, a change for how the financial system works, things like tokenization and stablecoins. But the dominant platform for these things is Ethereum. And so the Ethereum ETF provides portfolio access to any investor into this theme. So it's a great place to get started if you're interested in this idea. I teed you up, Jan.
Okay, so Zach is the ETH bull. I'm the Ethereum question mark. So can I have a show of hands here? If you think that Ethereum's transaction fees are cheap and fixed, please raise your hand. Oh, wow, this is a very educated crowd. Well, I take this with our clients, and they don't even understand that the transaction fees on Ethereum are variable. And if you go talk to a CTO and say, I'm going to build you a database on something where you don't know what it's going to cost you, they're like, no, thank you, and they run out of the room, right? So Ethereum itself, I love the idea, I love the technology, is losing market share and had to cut prices last year. And so I'm like, if you don't know those two facts, you should not be investing in our Ethereum ETF or anyone else's.
Yeah, and I would just add, as the largest crypto index fund provider, you should just own both. Just own Ethereum and Solana. You'll be happy. It is hard to say who will win between those two.
Maybe I just respond to that quick. I mean, in my view, Ethereum has significant moats that are not fully appreciated by the crypto industry. One of which is the fact that it has regulatory clarity in the United States that none of the other smart contract platform blockchains have. And so if your BlackRock or your Goldman Sachs or your Sony or your Donald Trump, Ethereum is the right place to begin because you have regulatory clarity around this asset. And we might be waiting years for that for all the rest of the smart contract platforms in the, at least in the US market. And then the other thing I would say is it's just much further along the adoption curve in terms of users, diverse applications, capital. Ethereum is much further along. People are still learning about Ethereum, but they're much further ahead on Ethereum than they are on all of its competitors. So I think that it has moats and is a great way, again, to get portfolio exposure to the smart contract platform theme.
Yeah, I'll just jump in, then you can respond. I put out a note this morning in my CIO memo. I think Ethereum is a great contrarian bet. But my actual bet is I think there'll just be different use cases. I think large-scale, high-value financial applications, particularly coming from the TradFi space, will be built on ETH. BlackRock launched its tokenized money market fund on ETH. Nike launched .swoosh on ETH. I think things where fractional cost and speed matter a lot more, and where not as much money is at stake per transaction will be built on Solana and maybe Monad and other things that are less developed. And you're seeing that. You're seeing a lot of DePIN, or decentralized physical infrastructure, be built on Solana and not ETH because it doesn't have the same, the trust factor is not as important. You pay for that trust factor on Ethereum, but that is a real benefit. You pay for that speed with less trust on Solana, and I think they can both thrive with just different use cases.
I just, I love Bitcoin. I just think Ethereum may or may not take advantage of this trend, and you just have to be pretty sophisticated to allocate to ETH. It's not just a blind plug it and play kind of asset. So I'm just trying to, give both the risks and the rewards. You very well may be right. ETH may have a great year. Like we could be seeing here next year, and ETH could rip. So I will hide my tail and go home. But I'm just saying, like, we just want educated consumers, all of us, right? And that's just have to understand the risks as well as the rewards.
How quickly does it evolve when you talk, especially Matt, with the points you bring up about the different platforms and the use cases and where you can find the best customizable outcomes for the unit cost by the time it's, in essence, is what you're saying. How quickly do you think enterprises or even individuals start to understand that construct, and how quickly do you think the diffusion factor happens, right? How quickly do certain types of customers understand and realize that certain platforms are more relevant or more indicative of the business that they should be doing on them versus others? It seems to me like that should be pretty quick. But this is also an environment where there's a trust factor from the corporate standpoint about how you even put these things into your daily lives.
Yeah, it's a good question. I think from an end user perspective, they're not going to care. How many people look at Polymarket odds? Lots of people. How many people know it's built on the Polygon block? Who cares, right? Who cares? You don't see that when you go to the website. So I think end users won't care. I think the people building on it are relatively sophisticated, but this should be making good choices. But this market is evolving really fast. What's state of the art today may not be state of the art tomorrow, and I think it's going. I think we'll see experiments on multiple chains, and we'll find out.
I mean, responsible, regulated entities like ourselves and any other company. The key is the same as for everyone in the audience. Know your customer. Right? And if that's retail customers, that creates a lot of friction in the crypto world. If it's B2B, if you want to start transferring money back to your company in Singapore, you're going to go through that process. And I won't get like fancier than that, but of course you want to make sure that the entities that Van Eck or Morgan Stanley or Bitwise or Grayscale are interacting with are also legitimate regulated entities. So that's kind of the infrastructure that mentally that has to be put in place, but is being put in place. And so that's one of the use cases is businesses sending money to each other, internationally especially.
Zach, from a trajectory standpoint, Grayscale as an asset manager was out front in many ways with the idea of being able to allow customers, investors, traders to be able to express views on certain parts of the market when it comes to these types of platforms. One of the big cases being brought up right now is about whether or not there is a way for the investing community to have a more seamless, understandable, and transparent way to be able to allocate. And I say allocate because for many advisors, there is an allocation function. And if there's an asset class, whether it's real estate, private equity, stocks, bonds, currencies, commodities, whatever it is, to be able to more effectively and efficiently just kind of direct flow. It doesn't seem as though it feels that way right now just yet. But the future of finance, if it is what you guys are talking about, has to involve that. How exactly, how far are we away from seeing products or platforms that allow investment advisors, high net worth individuals, corporate clients to be able to kind of index or diversify their exposure to many of these markets if they don't necessarily have expertise granularly for every single one of these platforms?
Yeah, where is the S&P 500 of crypto? Why do we not have that already? And I think the answer is we will in the not too distant future, but there is a number of things that stand in the way. At Grayscale, we have something called the Grayscale Crypto Sectors Framework that we built with FTSE Russell. People are familiar with the Russell 2000. This is the index provider. We have a variety of indexes that cover different parts of crypto and divide the marketplace up in the same way that you divide up the equity market by industry. You can divide the crypto market up by market sectors, and we can give indexes for all these different market sectors. They're not yet investable. Why are they not yet investable? Well, largely that has to do with the regulatory status in the US of many of these tokens, and it also has to do with a judgment call, I think, at least on our part, about what is appropriate to give investors. One of the great things about crypto is that it really is a free market. There is no permission. You don't have to ask anyone for permission to start up a blockchain and post your token. You just access the internet. What that means, though, is there may be assets that have a decent market cap that we don't feel are suitable for investors. So we're not ready to give investors purely passive exposure to the market like an SPY type of index exposure. But we will get there, I think, in the next, probably in the next year or so. And the election in November, needless to say, might have some say in how fast that timeline goes. It could be a little bit faster than our best guess, but it depends on how we vote.
Yeah, I would just add, we've been running a crypto index fund since 2017, has about $1 billion in assets. It is not quite like the S&P 500 because you have to screen out assets that have risks. So we screened out Luna and avoided that collapse. We screened out FTX's token. And so it has to have more intelligence built in, and that's going to be true as this market develops. But I think broadly, crypto's doing just fine on this front. If you think about other emerging areas of the market, think about when emerging markets became a thing to invest in. First, it was only large caps, and then it was large and mid caps, and then eventually we got total market, emerging market exposure. Same thing is true in crypto. In January, it was only Bitcoin. Now it's Bitcoin and ETH. That's 70% of the market. That's the same as large and mid caps. So we just have to get to the small cap part, but that'll happen over time. It's actually happening very fast, and we've been proud to be sort of part of the forefront of that.
I can't believe I'm going to pick a fight with two index people. So first of all, VanEck self-indexes about half of our ETFs. We manage about 110 billion. Love indices. We have our own crypto indices. Started in 2017. We have 20 outside clients. But I really going to pound the table for active management in liquid assets. I just think the space is evolving too quickly that I think an index approach, and we have some, and we have clients that do it, but I really think the active is better. So if you're a fiduciary and you're going to allocate, unfortunately in the US, you have to do that in a private fund, which I think all of us offer. So, talk to us later. But I just think there's too much, when you start screening out things like Luna, you're kind of edging a little bit more towards active management, right? And thank God you did that, right? Yeah. Because there are other famous people that got sucked up in that. And so I really believe in active management.
I have no tattoos, yeah. Yeah, I agree. The thing I would add on active management, I really believe in active management in this space too. I would just caution that there are extremely high quality shops, of which VanEck is one, and a wide diaspora of less quality shops. So it is a place where working with the best is extraordinarily important, even more important than other areas of the market.
Maybe I have one thought on active for the audience when you're sort of thinking about this. Why is it important to pick an active manager? It's different than stocks. Crypto blockchains don't have liabilities. There's no company. There's no buildings, there's no electricity bills, there's no employees, right? So there's no liability, so it has a harder time for these things to go to zero. And so actually with active management, what you're doing is avoiding the dead capital. I think that there's a lot of dead capital in crypto projects that maybe have a big market cap, maybe have some resources, but they're not going anywhere, really. And so active management allows you to kind of keep leaning in to the vanguard ideas in the space. At Grayscale, we do that by offering private placement products to accredited investors that we think are the projects that are most exciting. But I think the same holds for active managers. It's about kind of making sure the portfolio is leaning into the best ideas rather than sitting on the dead capital in the space.
Yeah. I would just say that it's worth pointing out the risk, which is that if you think crypto is a 10x or 50x market, buying the beta, if it's not perfect, is still pretty great. Allocating to a poor active manager that lets it all ride on Bitcoin Cash and Luna wasn't such a great option either. If you think back to the early days of the internet, lots of firms failed, but if you took an index-based bet and held it for 20 years, that was great. So indexing is never going to be the best strategy in this space, and it will hold a lot of dead capital and dead coins, but it's going to get you the beta. The best investment in crypto is just to buy it. And buy a lot of Bitcoin. So indexing is just sort of that, but a little more expanded. So there's, I think, a place for both.
But just a factoid for people in the audience, Bitcoin's up like 30% this year, and index of the top 100 tokens is down 20%. So that's a 50% return spread. So again, indexation doesn't really solve anything in anything. It's right. We know that for the equity market as well. But and before, like, my index colleague kills me when I get back to New York, like we do have a smart beta crypto index that screens for revenue generated by the protocol and the number of developers that are allocated to it, which are a little bit the things that Zach mentioned. But still, it doesn't have a lot of customer traction.
Yeah. Oh, 100's crazy. I mean, don't talk to an indexer that wants to go that deep. There's some wild animals down at 100.
Wild animals for sure. Okay, we've actually got a little bit of time if there are any audience questions. I'm just warning you that if there are not, I'm happy to take the couple of minutes that we have left. So if there are any audience questions, we're happy to let you open that up a little bit. Yes, sir.
How do you think RIAs ought to adopt technology? Like, for instance, you're talking about poised settlements and people's access to their own money. How do you give them that?
Oh, that's a good question. I didn't hear all of it.
Yeah. Can you repeat just a little bit?
How do we give people some of the things that they're going to want that are improvements on traditional banking? Like,
Oh, that's yeah.
operating in this traditional money system where people are like, yeah, I want some money to sell some stocks. We send them their money in a couple days. How do we integrate some of those improvements into what we're offering our clients?
Yeah, how can you, I think the question is, how can you implement some of the advantages of digital assets 24/7 and some of the security aspects, right, into daily practice? You know, it's funny, as we were talking about it, I was like, yeah, why is no one doing that? I don't think anyone's doing that to my knowledge, but let's talk afterwards and let's get that going. Maybe all four of us can get going.
Well, I think it's just a little early, to be honest. I think the best way to get these ideas into your portfolio is the Bitcoin and Ethereum ETFs. Is step number one, and then starting to use some of these AI tools is step number two. We're not quite ready for most U.S. banking customers to have instant finality. I think it may require regulatory change for the banks to be able to participate in this market. Before I worked full-time in crypto, I thought we could continue to press ahead with payments technology without participation of the major banks. I don't think that is true. I think the large commercial banks need to be involved in the rollout of a more modernized payment system, and that maybe requires a little bit of legislation before we get there.
Are you out of sync with Gen? Yes. Yeah. I think so. Yeah. They're going to do it. You have to think that they're going to access a lot of the services for free that advisors have built their business charging fees on for years. And what that means is you need to think about the other services that you can offer around those and assume that the net value of asset allocation and portfolio rebalancing and tax rebalancing and asset location and those, that's going to zero. It's going to be the individualized customized support you can offer, the individualized circumstance, health counseling. Some of the things you're hearing around here is how the practice is going to have to grow, because this is going to be table stakes, and the net you can charge on it, I think, is going to go to zero.
I think the specific to-do first step, right, is if your firm or your custodian could accept USDC, which is a leading, sort of U.S. regulated stablecoin, if you want to call it that. Happy to talk
Yeah.
about that.
I would just add, I would even if they don't, if you get comfortable, but if you get comfortable using stable coins, I think that will pay dividends in the next year. Just experiment with it individually.
We will have these guys available after this panel, but our time is over, and it has been for a little bit now. Thank you guys very much for joining us. Hope the conversation leads to some ideas of your own, and we'll see you guys at the rest of this conference. Thank you guys very much.